Hello friends, welcome to this video where we will see the importance of distinction between capital and revenue transactions. Previously we had seen what are capital and revenue transactions respectively. Today we will see why is it important to distinguish between the two. So in this video we will be seeing how an error or mistreatment of a capital transaction as a revenue transaction or vice versa would affect the financial position. So here is an example. I have just took only the figures and this is just an extract from the final accounts. Before we move into this example, it is important to understand that all the capital transactions will affect only the balance sheet and all the revenue transactions will affect the trading and profit and loss account. So the revenue transactions will affect the profit and capital transactions will not directly affect the profit as such. For example, revenue transaction is something like when you purchase goods. Purchases take place only in the trading account. A capital transaction is where you buy any long-term fixed assets. So fixed assets take place only in the balance sheet and not in the trading and profit and loss account. So capital transactions affect the balance sheet and revenue transactions affect the trading and profit and loss account. Here in this example, capital expenditure amounts to 5 lakhs, revenue expenditure amounts to 6 lakhs and the profit is 2 lakhs. On examining the accounts, it was found that the purchase of goods, which is a revenue transaction or a revenue expense worth 10,000, has been treated as a capital expenditure and recorded in the assets ledger. So, let us see how will this error affect the financial accounts. Now, purchases will be less of 10,000 and the assets will be more of 10,000. So, you're reducing your expenses and increasing your assets. This mistake increases the profit by 10,000. Now, the actual profit of 2 lakhs reduces to 1,90,000. So, when you treat a revenue transaction as a capital transaction, it unwantedly shows a hiked profit amount. Actually, the profit should have been only 1,90,000. But because of this mistake, the profit has been shown as 2 lakhs. So, similarly, if a capital expenditure is treated as a revenue expenditure, then it will unwantedly reduce the profit because you will be increasing your expenses and showing as a revenue expenditure and thus it will reduce the profit. It becomes inevitable to ensure that the treatment of transactions as capital or revenue is correctly made. Now the importance of this distinction is, first and major thing is it causes a big difference in the profit. The next thing is it causes a difference in the taxation because usually for capital profits the taxation treatment is different and revenue profits the taxation treatment is different. So by interlinking or mixing those two, we will be either in a situation to pay more tax or less tax. So thus because of these reasons it becomes very important to distinguish between the capital and revenue transactions properly and record them accordingly. So hope this short video made you clear why we should distinguish between capital and revenue transactions. So till we meet again in the next video, this is Sangeeta Selvan. Thank you.